making this press conference a success. Thank you.
All right, so we heard from the Reserve Bank of India governor in terms of additional takeaways, apart from what we already know in terms of the 25 basis point rate hike and the stance being maintained at withdrawal of accommodation, is the governor reiterating that the MPC is acting on data coming out of the domestic economy, not particularly global events. He also said that given that RBI has been moderating the pace of hikes from 50 basis points to 35 and now 25, it will give them elbow room to assess of the impact of the actions that have been taken so far. Again, no indication whatsoever that the market was waiting for on any kind of pause. The inflation outlook clearly, at least for the next financial year as well, remains well above the 4% median target that the RBI has in mind. Now, keeping that in mind, let me bring in our experts to further analyze some of the comments coming in from the Reserve Bank of India. By the way, the governor also alluded to the Adani issue without naming the company, of course. He did say that Indian banks remain resilient and the RBI has done its own assessment whereby it found that the banking system is stable and continues to be strong. They've fully complied, that is all the banks and NBFCs, with the large exposure framework norms, and the strength and size and resilience of the banking system is now much better than before to be able to withstand any kind of shock if it does come to that. The perception is largely because of the market capitalization of the conglomerate shares falling. But there he said again, there is limited exposure of banks on that front as well. Okay, so on that note, let me invite in Amandeep Chopra, Group President and Head of Fixed Income at UTI Mutual Fund. We also have Srinivas Varadarajan, MD of Global Emerging Markets at Deutsche Bank, Anubhuti Sahay, Head of South Asia and Economic Research at Standard Chartered Bank, and Abhishek Upadhyay, who's Senior Economist at ICICI Securities. He also joins us on the show. Amandeep, let me come to you quickly since you were with us earlier as well. Any additional takeaways on the direction of the policy now coming in after the press conference from the comments that the Reserve Bank of India governor and deputy governors have made?
I think 2 or 3 key takeaways. One is clearly, on questions around inflation and what would really sort of drive any change of stance. I think there was a fair amount of emphasis on saying that they want to see decisive moderation in inflation, which, I would assume indicates that they're not just comfortable with inflation coming within the tolerance band. Having highlighted the 4% target again in the presser, I think they are really looking at maybe certain set of data points which indicate that the headline is much closer to 4 and not just around 5 or 5-quarter levels, which is possibly where the markets were maybe drawing comfort. So I think that's one key takeaway. The other part, I think, is also to look at some of the opening remarks where I sense that there is an emphasis again by the governor in saying that the level of uncertainty still remains. While you've seen some amount of the so-called grimness or the concerns on global outlook declining, but the level of uncertainty given the risk elements, like the way we've seen some of the data prints come out as a big surprise contrary to the market expectation, still is out there. So I guess they don't want to be boxed into taking a very specific position on either the stance or the future path of policy rates.
Oh, yes, absolutely. And thank you for pointing out that's an important statement coming in from Michael Patra, the Deputy Governor, during the press conference, that when asked when RBI will shift its stance, he said when they see a decisive moderation in inflation, signs of that coming in. Let me pose that question to you as well, Anubhuti. What was your reading on that?
I think if we look at the statement as well as the press conference, it's pretty clear that RBI wants to be sure of durable disinflation. And if we just look at or talk about the next CPI print, that on its own is above 6%. And that clearly didn't give RBI or MPC, for that matter, any room to sound comfortable on inflation just as of now. As already highlighted, I think if we look at the past 3 years, it leaves very important lessons for us. In all the past 3 years, that is from 2020 to 2022, Fed policy, or Fed monetary policy, has always been a policy of continuity. Big shifts have happened only from April onwards, and that's because shocks have become, shocks were seen either in the later part of Q1 or Q2 of every calendar year. So I think if we look at the past 3 years, RBI's cautiousness was well justified. Now, when do we really see a decisive reduction in inflation? I think April probably we will get a better sense. In this, specifically, we are talking about the handle of inflation. As I mentioned, next inflation trend will be above 6%. That really didn't leave any room for the MPC to take a, to move back and not hike at all in this particular policy. But probably in the April policy meeting, assuming there are no further external shocks, we should have a better clarity that inflation has actually moved towards the 5% handle for good. That is for FY24. Of course, there will be risks which will need to be monitored, but probably that will be a policy where we can see RBI a little bit more comfortable on inflation rather than today itself. In terms of stance, I don't think April is a given in terms of shift of a stance towards neutral. Probably that would happen later in the year because, as the governor mentioned, there are a lot of uncertainties in the global environment right now. We need to see how US plays out, growth plays out, how China reopening plays out, the impact on commodity prices, etc. So probably more comfortable on inflation in the upcoming April policy meeting, but a shift in stance to neutral is still not a given in the next meeting itself.
Oh, okay, got that. Actually, I will have to persist with that similar line of questioning that Ritu has started. But I just wanted to add one thing that we got from the RBI management for insurance companies. So investors in insurance companies and insurance companies themselves, please pay attention. There is that lending and borrowing of government securities, which has been additionally provided in para 20 of the governor's speech. Now, what clarity we got is that the CCIL as an exchange will have a facility where insurance companies in particular can, lend their securities and take a line of credit. So that, I think, is a very important measure of liquidity for insurance companies. We will have to get some insurance company perhaps to react to it. That was just an additional information in the press conference. Now, to come back to the question that Ritu was discussing with Anubhuti, may I get others also on it? Abhishek, first you, are you any clearer on when the pause will come, whether it comes in April, and what they are watching?
Lata, so we expected this policy to be hawkish because clearly if you're looking at domestic factors, growth indicators have been resilient, and inflation, while headline has come down, you have, if you look at core inflation, it's very sticky. Momentum has come down a bit, but because of a weaker housing inflation, which we don't expect to persist for long. So core inflation worries and global uncertainty still remains high. So we thought it was too premature for RBI to be changing too many things right now. But there could be some shift in narrative as you enter April. Of course, in this policy, there was no clear hint that you're going to get a pause in April and a shift in stance. But a couple of factors which bear emphasis here. Firstly, and importantly, the liquidity side of the picture. So key reason we didn't think change in stance was warranted this policy was because core liquidity surplus is still 3 lakh crores. That is still very high. But as you come closer to April meeting, a lot of this surplus will be sucked out, partly because of TLTROs and also because of natural currency drain. So core liquidity surplus will come down. And secondly, even on the inflation side of things, you will come closer to the new fiscal year where inflation is expected to slow down. So Jan-March inflation still, at least our forecast is 5.9%, but April-June number is 5%. So you will have more information about how companies are exercising their pricing power as you head into March, and all that information plus, of course, international crude prices, etc., clarity on Fed policy, all these variables you will have more clarity on. And the baseline view we therefore still have is a pause in April and perhaps a change in stance. But it is, given the details of this decision, including the decision to retain the inflation forecast for first half of next year despite lower crude prices, and an increase in inflation forecast for second half of next year compared to the MPR, the risk is that we may not get both. We may get a pause, but perhaps for shift in stance, we'll have to wait for longer. We'll watch out for minutes of this meeting for forming up those views.
Got that. Okay, now we have another consideration, commercial consideration. I have to take a break, but we are back with a few more questions to our guests on the Governor's press conference. Back in a jiffy. Well, welcome back to our coverage of the Reserve Bank Governor's press conference post the monetary policy statement and the monetary policy announcement. We have been speaking with Anubhuti, Sahay, with Abhishek, Upadhyay, with Amandeep, Chopra, Srinivas, Varadarajan of Deutsche Bank, and in a bit we'll be joined by a banker as well. Srinivas, well, the same question to you. What did you gather from the press conference in terms of the next move of the RBI?
Listening to the governor, the deputy governors, the press conference, and the monetary policy statement, I'm reading the policy carefully. I'm kind of inclined to believe that probably this is the last of the policy hikes. There was an important paragraph in the governor's statement, paragraph 17, wherein he actually mentioned that they've kind of downshifted to 25 basis points. And from here on, they need to evaluate the effects of the past policy actions, which can also impact the stance. So I do believe that there is a good chance that a stance could actually change from focus on withdrawal of accommodation to a neutral stance come April. Again, I mean, if I kind of use a simple Taylor rule, without any discretion, using RBI's own forecasts of growth and inflation, forward inflation of 5.6 and 6.4 on growth, you're really coming up with a real policy rate at the current, at the current policy rate of 6.5%. The real rate is about 85 basis points. So it is really within the range of 70 to about 95, which was kind of indicated in one of the occasional papers in the Reserve Bank of India. So I think given the current information that we have, absence any shock from overseas, we should get into a pause mode with a change in stance. One of the things I'd like to kind of point out, when I look at the entire policy, I look at it as a composite whole. I also focus on the balance of risks, in the forecast that they come out with. And I'd written about this some time back. There's one interesting nuance over here, which is that the balance of risks on growth moved from broadly balanced to evenly balanced in the December policy, which kind of told me that maybe they're concerned about growth. While in this policy, there is a bit of, the governor's statement continues with the characterization, which says that the risks to growth are evenly balanced, while the resolution says that the risks to growth are broadly balanced. So I'm not sure which prevails, but I would probably go with what the governor has said, and maybe the risks to growth are evenly balanced, even as they continue to characterize the risk to inflation as being evenly balanced. So, I mean, taking a composite whole, we've kind of come a long way in terms of the rate hike cycle. And it's probably the right time to kind of pause and reflect and see how this kind of feeds through the rest of the economy.
Up everyone's thoughts then, and given that the Deputy Governor in his own words has said that the shift in stance will only happen when there is a decisive moderation in the inflation print. Quick one-word answers from all of you, starting with you, Amandeep. Where do you see the peak rates in this cycle now that we do not know if at this juncture there is a pause or not?
Ritu, it's, I think, going to be very difficult. And I still come back to, the original point I made. I think there is something very consistent in the way central banks around the world are communicating to the markets in saying that, quite honestly, they don't know themselves. And that's really one of the reasons why all of them are keeping their options open. And this, high for longer, trying to, decisively or conclusively bring inflation down seems to be the common narrative across central banks, whether it's the Fed, Bank of England, ECB, and now even RBI.
No, it's
so,
certain.
I would not really venture out on giving a peak or a target repo rate right now. I think it's an evolving situation. And I agree with what Srinivas mentioned. They have, left a slight window available for them to recalibrate themselves depending on incoming data. And I think that's really going to be the theme for the current year.
Well, of course, actions will continue to depend on data coming in. So it's difficult to second guess at this point of time. But Anubhuti, quickly, your thoughts?
Today's rate hike, in our view, was the final rate hike in this cycle. We now expect a prolonged pause. And just to reiterate, I think the hawkishness which was there in the statement today was purely targeted to squeeze out expectations of rate cuts by end of 2023, rather than shift the peak as far as the repo rate cycle is concerned.
Okay, and Srinivas?
No, I think that the focus should now move away from policy rates more on the liquidity outlook, right? I do believe that the possibility of going to a more neutral liquidity situation is increasing. There is going to be the TLTRO, which sucks out the liquidity from the market. In addition to that, RBI's own holdings, which we kind of estimate to be about 40,000 crores, will amount to a passive quantitative tightening, if I could use that word. So increasingly, I do believe that the marginal reserve to the system will be supplied by the Reserve Bank of India, which really means that how do I see this kind of evolving forward? I go back to the February 2020 circular, the new liquidity framework, where they basically said that they kind of characterized the 14-day as the main operating rate. So I do believe that probably the stage is set once liquidity is being completely withdrawn and they supply the marginal reserve, that the policy rate itself that the Monetary Policy Committee can vote for would be the 14-day rate and not the overnight rate. And this, the setting for that is pretty much going, is kind of going on, right? So that's the change that I do expect in the days to come.
Okay, and Abhishek, quick final words from you.
Well, I agree the policy was hawkish today because RBI didn't want financial conditions to loosen prematurely, and that incremental tightening in monetary conditions will come from the liquidity side. The baseline view is this was the final hike, but we don't expect any rate cuts either. If you look at the swap markets, they're pricing in about 2 rate cuts in the back half of next fiscal. That is not what we anticipate. At current level of policy rates, we are still firmly below the peaks we have seen in the past cycles. While this is the final hike, therefore there should be no cuts either.
Okay. All right, gentlemen and Anubhuti, thank you very much for joining us and giving us the benefit of your analysis of the press conference. We have now a banker joining us, a commercial banker, so we would like to know how much our loans or our EMIs are going up and how much we earn more in our deposits. Shanti Ekambaram from Kotak Mahindra Bank has joined us. Shanti, thank you very much. Well, first up, for several banks, are deposit rates likely to rise a little more than lending rates?
So firstly, Lata, I think deposit rates have been rising in tandem with rise in repo rates, and keeping the credit growth that is strong in the system. Deposits have been and will be center stage for most banks. So I think it really depends upon the demand and the supply. And if banks have less supply and more demand that they have need for money, they will rise rates. Different banks will take the ALCOs of banks will take. But I think you can expect some marginal rise in deposit rates on the basis of what you have seen as a rise in repo rates. But I think banks have already taken the steps that they need so far in mind.
Okay. No, I'm asking because everyone knows that if the repo rises, all the lending rates linked to repo will increase. But we don't get a very good handle on deposits. So I'm asking you if in the next quarter, you are expecting another quarter basis point hike.
So Lata, that's what I come back to say. It really depends upon the demand supply for money, because each bank looks at what is their likely growth, which is the demand for money, what is the supply they're getting from CASA, what is the liquidity, and then they decide based on their deposit rates. I think banks have moved pretty significantly in the last, I'd say, 6 to 8 months on deposit rates. And in my mind, it could move up marginally. And really, and if the credit growth continues to be strong, you could see, a continued tandem between the deposit and the lending rates. But it's really a demand-supply mix and how liquidity is going to play out from here.
I agree. So you are better placed to gauge that demand. So I wanted to know whether you think that as lending rates rise, 6.5 for the sovereign and probably 7.35, 7.4 for the 10-year. Do you think that demand could peter out, could plateau a bit or slow a bit?
If I heard the governor, and in fact, that is one of the surprising parts, I actually found the estimates of economic growth and inflation for next year higher than what most economists had, put out or even anticipated. So if the economic growth continues to be strong, and you saw that at 6.4 estimate, I think the street economists were at 5.6 to 6%. Then the demand and supply, the demand for money is likely to continue. You heard the governor say buoyant, sectors, urban consumption, rural coming back, and all the various agriculture better because of the Rabi crop. If that happens, and let's say if the world recession is not as bad as one expected, which is also perhaps why they've kept some buffer in the policy on the inflation side, then you could see the growth, Indian economic growth higher. If there is growth, then there will be demand for money. If there's demand for money, depending on the supply, right, you could see a marginal rise in deposit rates, which is what I'd said right at the beginning.
All right, Shanti, hi, this is Ritu. Let me come to the other non-policy announcement as well, and the one regarding penal interest rates charged by banks that are varying and RBI finds excessive in some cases. Of course, they're different across banks, but what is your sense overall with these draft guidelines coming on? What would be the impact?
So firstly, as you know, the penal rates are actually set as a policy and is approved by the board of the banks. And if you look at across the industry, there is more or less, they're all in range. And there is a penal interest and there is a penal charge. It's reasonably in line. We have to wait to see the draft guidelines to check what is it that is being seen as excessive. And obviously the draft guidelines will be viewed and we would give all, feedback. So we really need to see whether this excessive will, impact banks, non-banks, I don't know. But I'm saying it's reasonably standard across the industry. It's a part of the contract which every customer signs. So I think we have to wait and see what exactly is the draft guidelines referring to.
Shanti, the other thing also that the governor brought up was expanding the scope of the threats. Now, what they've said is that insurance facilities will be permitted on it. They've also said secondary market operations will be enabled on the threat platform as well. Do you think, sum and substance, will this move the needle for small entrepreneurs, for MSMEs?
So if you look at what Threads has done, Threads has actually brought the rates pretty competitive for whoever is accessing the platform. At least on the supply chain, which is, the buyer's credit, etc., has been reasonably, you've seen that there has been competitive rates. I think by developing a secondary market for receivables, I think it will deepen the market and thus, make it competitive as well as a reasonable rate for MSMEs. I think it's a very good move. I think what needs is that more and more people need to get onto the platform. More and more there are buyers, there are sellers, there are discount, there are financiers. I think it's a good move and will be able to provide liquidity at a reasonable rate to the MSMEs if this really is played out well.
Okay. Well, Shanti, we will invite you for a separate chat on Kotak Mahindra Bank some other time. Thank you very much for joining me. Between Ritu and me, we have eaten half of business lunch. So we wind up on the note that the Reserve Bank has left it ambivalent on what they will do in the next policy, whether it is a pause, have indicated that they would be pretty much data dependent, with an indication that they are still cautious on inflation. That's it on the special coverage of the Reserve Bank of India monetary policy and the following Governor's press conference. It's over to business lunch after a break.